Dave says he sent a question earlier via email, but I thought you would post it here in case you aren't in your email. Yes, just real quick, Dave, know that I turn my email off about 4:25 p.m. Eastern time, 4:20 p.m. Eastern time sometimes if I'm working on slides from other questions. So if you send it just before the webinar, I probably won't get it. Also, if you send it during the webinar, I'm not going to see it. And why? It's because no matter which tray I put it on, you'd see the pop-up come up here with your name, your email, your subject, and so forth. So that's why I have the email turned off during the webinar. But let's get to it. You said send a question earlier via email, but I thought I would post it here in case you weren't. So here it is. I had the following position in my IRA account, 132 shares of Amazon. All right. Good. Good. Average purchase price of $120.79, 5 points lower than I am. I bought a few shares this past week to average up my cost. Sold one call August 5th, 125. Okay. So today I'll be giving over 100 shares at 125 with the stock trading at 140.87. That's correct. Let me just see if this is going to give us a good view or if I should just drop it down to 100 shares. Oh, sorry, you said 125 call. Yeah. And let's just say you got maybe at the time 40 cents or so. It was probably higher than that. Let's say 60. All right, so let's take a look at the structure first, where we are. All right, now it still has an increased unlimited upside because the extra 32 shares. It's not a standard covered call, but yes, we're going to get assigned. You're going to get assigned, excuse me, at 125 with stock trading. If there's something I could have done in the advance of today to mitigate this discrepancy between the current share price and what I'll be giving over at. Rolling looked like it was going to give a credit, but not enough to offset the loss. Okay, so what else could have been done? Thank you for taking my question. And I'll be dialing into the webinar at 4:30. Well, Dave, I'm glad you dialed in. All right, so if you wanted to hold, now I know this, let's take a look at the chart. I know this is mostly because of earnings. And that was, let's see here, the 27th, if I'm not mistaken. No, I'm sorry. It was much later than that. I apologize. It's 28th to 29th. So there's the earnings pop up to 135. You're hovering around 125. Your call strike, fantastic. Then the earnings popped. And so July 28th. This is the same dilemma. I mentioned the gentleman in the other married put position. You're in a covered call, Dave. That's fine. But the other gentleman in the married put position had where his sold the 70 strike call, and it was now at $79 after a 2-3 day run after earnings, just like Amazon here. What could I have done beforehand to mitigate this? Well, one thing I always say is when you enter any position, when you sell a call, enter a covered call, unless this is your strategy, but when you enter a covered call position, if you sell a call against a married put, always check the earnings first to make sure that if you still have a positive earnings on the position, you want to leave yourself with some upside as well. Okay. All right. I was saying, sorry, he got 154. That does seem like a much better price. Now I'm just going to assume that you did this around July 27th or so. It doesn't matter the date, but why am I going to do that? I'm going to go here just for a minute. I'm going to go to Apple. I'm going to go to the chain. Yeah, let me go just to calls first, folks. And then I want to go to July 28th or July 27th. Okay. And I'm in Amazon. Oh, Fridays are popular A stocks. Let's get that correct, shall we? All right. So on the 27th of July, Amazon, not Apple, was trading at 120. 125 is about 195. Not probably a different price. July 1st. Okay, that's fine. But because now, even as we're getting closer to earnings, you sold this call for 125. I'd like half, and I'm going to take half. Here's the 131 call at 57 cents. So on July 27th, as we're getting closer to earnings, this is one step. This is not always the best step, but this is one step. Because it was trading, I'm sorry, 57 cents midpoint, yeah. You sold it for 154, excuse me. So we're going to buy this one for 57. By itself, what is that? It looks like a bear call spread, isn't it? Selling the 125 call, buying the 131. But in the construct of owning the stock, or in a married put position, this leaves the upside completely open for further gains. Yes, there's a little hiccup here. And the married put, it looks different. We're going to look, let's take 100 shares to show you how this looked like with just 100 shares. You had the additional 32 to help your upside. But a good approach going into earnings, if you're expecting a higher move, is to enter the position. Now, you still get $1 of premium to help the cost basis of the 100 shares. But now the extra long call, I'd like to be closer personally, but I did it because it's half. I looked at, if I already have a call open on my married put, I'm going into earnings, and I know earnings is 3 or 4 days away. I'm either going to close the call honestly and leave the upside open, even if I'm closing it for a debit, if I'm really bullish and expect really good expectations. But another approach is simply this. Buy the extra call if you're expecting a good, positive, strong earnings. Try to only use half. Now, this is sometimes more difficult, okay? Because what do I mean by that? Now, your call space was 120.79. You sold the 125 call. If the stock was already at 130 on the 28th or the 29th, then I'm probably having to go to the 138 to get 57 cents. The others are going to be pretty expensive. And there's no one, Dave's follow-up question is, how do you know which option to choose then? It's more of pick and choose. In general, if I've already sold a call and I'm going to use this approach, the whole approach by itself is income method number 6 in the blueprint for the married put structure, Dave. But what I would look to do is pay 50% or less of the call premium I initially received if possible, without going too wide. In other words, since the whole market knows earnings coming up, this might have increased in implied volatility and gotten more expensive. Thankfully, it was only 57 cents. That wasn't bad at all on the 28th for the 131 call because the stock was still fluttering around the 120 range. Or 122, was it? Sorry, folks. 120, yeah. So, but you had already committed to the 125 call. I don't want to take off more than half of what I originally received, but in case there's a blowout, let me leave some upside open in this case and do it that way. That's the main rule I use if a call is already open for me personally. This has to be less than half of what I took in. And, you know, you get this little line here. This would be just like getting assigned at 125. Now, don't get me wrong. In this theory, in this approach, adjustment, whatever you want to call it, Dave, I am in a bear call credit spread technically. When we take out the 100 shares at 120.79, we're in a bear call spread that would have been disastrous. And we would have had to put up $600 worth of margin to cover the spread between 125 and 131. But owning the stock against the position, of course, that removes the obligation, and the nested bear call spread in the stock or even the married put structure, it doesn't matter if you own the stock underneath of it, removes the extra monetary requirements, just a covered call with an extra long call. That's how the broker sees it. Now, your profit is still high. This does not necessarily, depending on your broker, how the trade was entered and how they read the trade, this does not negate you getting assigned at 100 shares of Amazon at 125. That would still likely happen today in the structure. But then you have the right to buy another 100 shares at 131 of a stock trading at 140.80. So you're still going to have this profit graph, but you still might get an assignment on your original 100 shares. And if you left it open without making any adjustments or rolling it before the close today, Dave, they would buy another 100 shares for you at 130, which would increase your cost basis in that case, and we'd still there. Okay? Yeah. So you're going to go at 125 on those 100s. Yeah, and you says rolling. Looked like I was not going to give enough credit to offset the loss of rolling, so I didn't roll. Okay, now remember at any time, but you want to track this as a standard position. What do I mean? Not this, not this adjustment, but this is the idea that is I'll use around earnings. I'll use around my married puts. I'll just enter a straight income method number 6, even if I don't have a call sold. Oh, shoot. That's not what I wanted to do. 120.79, right, Dave? Yeah, there we go. All right, so let me submit that one last time. This is just the static covered call, still a good 4.8% return, but we missed out on the upside. Now let's add it to the portfolio. Oh, who doesn't really matter, of course. Hey, I need a portfolio. We haven't visited that one in a while. So we're going to put it in there. July 1st, you had mentioned. Now, I'll enter any of my positions into the PowerOptions portfolio. I haven't really, okay, it's May. Yeah, we haven't visited this portfolio in a little bit. And, oh, wow. Sorry, wow. That's devastating. Okay, so, now that coin was below 50 at one point, I believe. Sorry, got distracted. As you're tracking any position, Dave, what you're going to want to do here is go to position actions and then position analysis. Okay, and so this gives us a breakdown of our position, a profit and loss chart. Yeah, we're at 0 time value because we're at 0 days to expiration. And as we scroll down, hey, we've made our max 4.8% and 99.6% of what we expected to make on that position. And then here are some rollout opportunities. And you're absolutely right. But what I always say in these scenarios is if you're still bullish on the stock, it may be okay to roll for a debit if it matches your target. And what do I mean by that? Well, you had let's just call it a 30-day position, July 1st to now. We had 4.8% max expected return. So you're expecting 4.8% every 30 days. Now, what this is showing us is here's the cost to buy back our current call. Let's assume market hasn't closed yet. Original premium received, our buyback cost. And then it shows us the rolls available. If we roll out to August 12th, we're only going to get $257 for the next 7 days with the 141 call. We're adding $11.72 to the cost basis. But if we get assigned at 141, it's a 6.4% return. Okay, we're only up 1.6%, but that's for 1 day. I'm sorry, I wish. That's for 1 week. Sometimes it's okay to roll for a debit if you're matching your trading plan, whether it's an additional 7 days out. I want to double it 14 days out. Well, it's a little tough, but yeah, we're up to 8.9%. You're getting closer. It's the 145, but yes, adding to the cost basis. Here are some ones. Oh, what are the highlights, Dave? I'm sorry. The highlights here are showing you which one, the same expiration, which ones are in the money still. You could still roll to an in the money, but you're paying less of a debit, but not 1.5% increase. This is if you're assigned at the higher strike, selling out of the money. 144s, you get extra appreciation, but you still have a high debit. So you can scroll through, and the only credits, you're right, we're going to see are either in the money still, but increasing our return slightly. But I don't know if we'd go out another 28 days for a meager 1.4% return. You're probably looking more in this range, again, for a higher debit. And I'm just going to scroll a little bit more, folks, because I just want to see, is there any point? Oh, there's a lot of Septembers, I guess. Oh, it's all the weeklies. I apologize. And yes, gray. Nope. Maybe. Nope. Okay. I paused the screen so you guys wouldn't see that scrolling. If we roll to the at the money October 145, it's still a debit of 696. But if I get assigned at October at 145, it's a 13.5% return. But that's for 77 days. This is the trade-off we evaluate. This is why the trading plan is important. It's okay to roll for a debit if you're still bullish on the stock and the new percent if assigned or potential return matches. What is the drawdown? Increased cost basis, you technically have a negative downside protection. All right, I increased this by $7 or $8 here to the September. Oh, let's go to standard September. Let's go to that 143, 142 call. Oh, let's go 142.5. So we have to buy back at 15 something. You took in $1. We're going to get 580 by selling the 142.50. We still have a debit of 849. We increased our cost basis from 120.79 to 129.18 or 20. But if assigned at 142.50 in 42 days, it's a 10.2% return. You've doubled it. It's great to see things numerically, but as you're evaluating rollouts, Dave, on covered calls or naked puts or any of the other strategies where rollout opportunities appear, click the More Information button next to the position and go to Simulate Trade. This gives you a side-by-side comparison of your position. Sorry, the graph isn't all the way down to where you'd see the loss there at 125. But yeah, so what are we doing? We're taking our cost basis from 120.79 up to 135.08. So that puts the new break even at 129. So as the stock falls now, if it falls below 130, you're now losing money on the position. But again, we've taken a return of 4.8% on the covered call up to 10.2 with the adjusted effective cost per share for rolling the position. This gives you a side-by-side comparison so you can see it. Now, unfortunately, this had cut off due to the increase in stock prices. So what we're missing is that extended line as we went down to 120, 115, and so forth. Okay. All right. I'm sorry. I'm just thinking to myself. I'm writing notes to a programmer on my notebook so I can text him later. All right, but that's the power of the portfolio tools there. Tracking the positions. Let's go back. Tracking the position initially. You're able to see the the current cost here. I'm in the stock analysis view, the standard view. Let me go back. The standard view shows you each individual leg, but it always tracks the positions as linked positions for an easier view. So you can say, yeah, I'm up 2,000 here, but I'm down 14 here. Linked strategies, spreads, married puts, collars, covered calls. I always prefer the stock analysis view in most cases because what the stock analysis view does, it adds 6 more columns to the right-hand side. So I see the total position cost of stock and call, original expected return, current expected return, and of course, expiration gain or loss right now in those cases. So when you have linked positions, it's easier to see. When you just have a long call or long put, maybe even a naked put, it might not be necessary to do that, but covered calls, spread strategies, and more. And of course, I can always set alerts on the position. So I sold the 125 call. Maybe I wanted to be alerted if the stock price was trading above 126, for example, because I might want to consider rolling the position, or if it's down below 114, where I might be losing on the trade. Or if I'm within 3 days to expiration, I'll just make that a neutral one. Or if you have a delta limit you want to use, or if your call is too deep in the money, you don't want it to go more than 3 or 4% in the money, you set that here too. For my married puts, I usually look for positions where the stock's above the 20-day moving average or the 50-day moving average. So I want to be notified if the stock drops below the SMA 20. That might be time for me to consider an income method or something along with it. I use this mostly with the bull put credit spreads, by the way. If the trend changes, I want to know about it, even though I might not have hit my other stops for credit spread, bull put, or bear call. Okay? All right. So we save the alerts, and then the alerts are triggered. We know that we've hit our upper stop limit here as well. If the other limits, not the 20-day moving average, obviously must have been hit as well. Okay. And so now that my alert's been triggered, what am I going to do? I'm going to go to position actions and position analysis, see where I stand, see my current liquidation value versus future expiration value, but I saw that on the black one there, on the back one, excuse me. And then I see my rollout opportunities based on my trading plan, which one still gives me the return I potentially want without increasing my debt by too much to continue the trade going forward. That's the power of the analysis. And then, of course, if I make any rollout opportunities, it'll record for me in the history transactions, for those positions. Okay. And that's in the, analysis by symbol or analysis by position. So you see the AIG position, we've made 2 adjustments on here. We sold a call that expired worthless and sold another May call that expired worthless in our current open positions of the stock and the put option on the position.